Welcome to The Explainer. Okay, let's just jump right into it. Today, we're unpacking a highly controversial, incredibly timely issue, the billion-dollar-plus condo bailout debate. For well over a decade, we've all been told that skyrocketing real estate prices were basically the ultimate proof of a booming, healthy economy. And during that massive run-up, well, developers were raking in record profits, investors were building massive wealth, and the housing market honestly felt like an unstoppable machine. But fast forward to today, and that narrative has completely flipped. We're going to dive in and explore whether Canada's housing policies are accidentally socializing massive losses while keeping all those earlier profits strictly in private hands.
So here's the billion-dollar question we're tackling. Why are everyday taxpayers suddenly being asked to rescue an industry that made literal fortunes during the boom? The market dynamics have taken a huge U-turn. Buyers have essentially vanished, and suddenly, these massive developments just aren't financially viable anymore. Yet the exact same industry that cheered on the high-risk, high-reward nature of the housing boom is now turning to the public to absorb the shock. Critics are asking a really fair question here. When private companies make billions in the good times but expect society to share the pain in the bad times, is that actually free market capitalism? Or is it starting to look a bit like a publicly funded protection racket?
All right, Section 1, the Canadian housing machine.
To really wrap our heads around this debate, we kind of have to look at how this machine was built in the first place. The whole system ran on this incredibly dangerous assumption that property prices would just go up forever, right? It all kicked off with cheap money. Those historically low interest rates triggered massive waves of speculation and foreign investment. Naturally, that intense demand pushed prices to absolute record highs. The result? Developers and investors were rewarded handsomely, while an entire generation of first-time buyers got completely boxed out of the market. Housing stopped being about local incomes and a basic human need and started being treated more like a hot stock on a global exchange.
And that brings us to a really glaring contradiction, which is honestly one of the most controversial parts of this whole debate. Back during the boom years, when foreign buyers were turbocharging demand and jacking up prices, industry groups insisted they weren't a problem. They'd say, oh, it's just a tiny fraction of the market. But the second government stepped in with restrictions, and those restrictions actually hit the developers' bottom lines, suddenly it was a severe five-alarm crisis. For critics, this perfectly illustrates that the industry was never really defending the health of the Canadian housing market. They were just fiercely defending their main cash cow.
Moving on to Section 2, when the market turned. Look, the party couldn't last forever, right? Economic gravity always catches up eventually. Based on rigorous analysis from places like the C.D. Howe Institute and the Hub, the real trigger for this bust was simply rising interest rates, not international trade pacts like CUSMA. The exact same market forces that drove up those unprecedented gains suddenly whipped in the opposite direction, creating massive losses. Practically overnight, developers were staring down sky-high borrowing costs, tanking sales, and zero investor demand. It left them stranded with canceled projects and half-baked condo towers that suddenly made absolutely zero financial sense to finish.
But while developers are definitely feeling the squeeze, we really can't lose sight of who is bearing the absolute most weight here. This market shift has been devastating for everyday citizens. Why? Because Canadian household debt currently sits at a staggering 103% of our GDP. Based on deep dive data from the Hub, that is literally the highest household debt burden in the entire G7. Everyday Canadians are already stretched to their absolute financial breaking point just trying to keep a roof over their own heads.
Which brings us to Section 3, privatized profits, socialized losses.
This is the absolute core of the criticism against this proposed developer rescue. It's a dynamic that a lot of people feel is fundamentally, wildly unfair to renters, first-time buyers, and taxpayers alike. We hear the phrase socializing losses tossed around a lot, but what does it actually mean in practice? It's a system where the public is forced to absorb the financial hit when private businesses fail. So the really potent question critics are raising is this. If the system generated historical, record-breaking profits for private companies for years, why on earth should the Canadian public suddenly have to act as a taxpayer-funded insurance policy the minute those speculative bets go sour?
Just think about this comparison for a second. During the boom, developers and investors pocketed billions with a B in record profits, while everyday Canadians were completely priced out of the dream of home ownership. Now we're in the bust phase. Developers are asking the government for a bailout, and those exact same everyday Canadians who couldn't even afford to buy the homes being built in the first place are effectively being asked to foot the bill. The upside was strictly VIP for private investors, but the downside, well, that's suddenly everyone's collective problem.
Let's look at Section 4, the moral hazard problem.
Bailing out developers isn't just about the hit to the taxpayer's wallet today. Economists are actually sounding the alarm that it damages the fundamental mechanics of our free market going forward. The massive danger here is what economists call moral hazard. You see, a healthy market actually requires something pretty uncomfortable: failure. Failure is a vital signal. It tells investors, hey, that strategy was too risky, or that price was totally unrealistic. If we send a message to businesses saying, keep all the profits when you win, but don't worry, the government will cover your losses when you lose, we literally strip away the risk of failure. And without risk, they're just going to keep making reckless gambles, assuming a rescue is always right around the corner.
Section 5. Transparency and public trust.
This tees up a huge issue championed by groups like Democracy Watch. We urgently need strict government accountability and a hard stop to secret lobbying, especially when billions in public funds are sitting on the table. Before a single cent of taxpayer money goes anywhere near the housing industry, accountability watchdogs are demanding clear, transparent answers. Like, which specific companies are actually getting this help? Exactly how much money are we talking about? And crucially, what are the strings attached? If we use public money to save a failing condo project, are the developers forced to lower the final sale prices so Canadians can actually afford them? We deserve to know who's approving these deals and who will be held accountable if the whole thing flops.
Because at the end of the day, the appearance of independence really matters. When you're dealing with billions of dollars, political accountability isn't just a buzzword, it's paramount. Keeping these details hidden in the shadows doesn't just mask a bad deal, it actively destroys public trust in both our democratic and economic institutions. And naturally, that leads to some intense scrutiny of our political leaders. For instance, commentators have pointed out Prime Minister Mark Carney's previous leadership role at massive institutional investors like Brookfield Asset Management. Now, let's be completely clear here. A professional connection alone absolutely does not prove any wrongdoing. None at all. But critics are totally justified in asking whether the rules are being applied equally when political insiders have deep historical ties to the massive institutional investors who stand to benefit from these very housing policies. When you're handling public money, avoiding even the perception of a conflict of interest is just absolutely vital. Finally, Section 6. Who really pays the bill?
Let's follow the money right to the end of the line. If these bailouts actually happen, we have to know who is ultimately cutting the check for this developer rescue. As the Hub recently highlighted in their economic breakdown, top-earning Canadian families are already carrying 65% of the country's income tax burden. Throwing a brand new billion-dollar bailout on top of that just to stabilize private developments, that is an enormous strain on a tax base that is already stretched to the limit. Whether you're a top earner or an everyday taxpayer, this is public capital being siphoned away from other vital public services.
So, what's the alternative? Instead of just padding the balance sheets of private, for-profit developers, critics argue the government has much better options. Why not directly support first-time buyers? Why not pour that funding into dedicated, affordable rental construction, homes that will never be flipped for a quick profit? Why not invest those billions directly into the community infrastructure that actually supports housing, which would directly lower the cost of living for Canadians who are staring down this affordability crisis every single day?
Look, Canada undeniably needs more homes. There is no question about that. But how we get those homes built really matters. I'm going to leave you with this provocative thought. When the housing investment machine inevitably breaks down, who should genuinely carry the risk? Should the investors and corporations who made those bad, speculative bets pay the price for their own decisions? Or should ordinary Canadians, so many of whom have been completely shut out of the housing market entirely, be forced to cover their losses? Thank you so much for joining me for this explainer, and I highly encourage you to keep questioning exactly where your public dollars are going.